Mutual funds. Which one is better for you? Have you ever felt overwhelmed trying to understand the difference between index funds and mutual funds? You're not alone. These two popular investment vehicles are everywhere, but many people still don't know how they actually work, how they're different, and most importantly, which one is better for your financial goals. In this video, we're going to break it all down in simple terms. No jargon, no fluff. By the end, you'll not only know the difference, you'll know exactly which one fits your investing style. Let's get started. Imagine this. You're ready to invest. You open a brokerage account and you're faced with hundreds of options. Some say mutual fund, others say index fund. They look similar, but they aren't. So what's the real deal? Let's start by defining each. What is a mutual fund? A mutual fund is an investment vehicle that pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. These funds are actively managed by professional fund managers who aim to beat the market. They research companies, make investment decisions, buy and sell assets, and try to achieve better returns than average. You pay them a fee to manage this for you. That fee is called the expense ratio, and it's often higher than index funds. On the other hand, what is an index fund? An index fund is also a type of mutual fund, but it's passively managed. It's designed to mimic the performance of a specific market index, like the S&P 500 or the MSCI World Index. Instead of trying to beat the market, it tries to match it. So when you invest in an S&P 500 index fund, your money is spread across the 500 largest companies in the US, automatically, and without the need for a manager making daily decisions. Now that we know the basics, let's break down the key differences between index funds and mutual funds. Difference number 1, active versus passive management. Mutual funds are actively managed. This means a human being or a team is constantly adjusting the portfolio, buying or selling stocks based on their research or predictions. Index funds are passively managed. They don't try to beat the market, they just follow it. So if a stock drops out of the S&P 500, the index fund will drop it too. No opinions, no timing, just tracking. Difference number 2, costs and fees. Because mutual funds require active managers, analysts, and trading teams, their fees are higher. The average mutual fund expense ratio is between 0.50% to 1.50%. That means for every $10,000 you invest, you're paying $50 to $150 per year in fees, whether your fund performs well or not. Index funds, however, are much cheaper. Their expense ratios often range between 0.03% and 0.2%. That's just $3 to $20 per year for every $10,000 invested. Over time, those savings can add up to thousands. Difference number 3, performance. This one might surprise you. Even though mutual funds are run by professionals, studies show that the majority of them fail to beat the market consistently over time. In fact, over a 10-year period, more than 80% of actively managed mutual funds underperform their benchmarks. Meanwhile, index funds perform right along with the market. No surprises, no big risks, but no unnecessary losses either. If the market goes up, your fund goes up. If it goes down, you follow, but you're not paying extra for underperformance. Difference number 4, transparency. Index funds are more transparent. You know exactly what's in them because they mirror an index. You can look up the holdings anytime. Mutual funds may not disclose holdings as frequently. You might only see quarterly reports or summaries. If you like knowing where your money is, index funds are the clear winner. Difference number 5, taxes. Because mutual funds are actively traded, they may generate more capital gains, which you may owe taxes on, even if you didn't sell any shares yourself. Index funds have lower turnover, which often leads to lower tax liabilities. Less trading, fewer taxable events. This makes index funds more tax efficient for long-term investors. Now that we've covered the main differences, let's look at the pros and cons of each, starting with mutual funds. Pros of mutual funds: professional management. You're relying on experienced managers to make decisions. Potential for higher returns during short-term market trends. More tailored strategies like sector-specific funds or thematic investing. Cons of mutual funds: higher fees, underperformance compared to benchmarks, less transparency, higher tax impact. Now the pros of index funds: low cost, market matching performance, high transparency, tax efficiency, great for beginners. Cons of index funds: no chance to outperform the market. You're always tied to the index, even during downturns. Fewer options for niche or specialty strategies. Now you might be wondering, which one should I choose? The answer depends on your goals, risk tolerance, and investing style. If you're a beginner, want low fees, and plan to invest for the long term, index funds are an excellent choice. They're simple, affordable, and consistent, perfect for building wealth over time. If you prefer a hands-off approach and want to avoid the stress of picking stocks, index funds are for you. However, if you believe in active management, are willing to pay higher fees, and are looking for short-term gains or niche investments, you might consider mutual funds. Some people even use both: index funds for their core portfolio and mutual funds for specific strategies or sectors. So how do you get started? If you want to invest in index funds, here's how. Step 1. Choose a brokerage platform. You can use apps like Vanguard, Fidelity, Schwab, or even modern ones like Trade Republic or Scalable Capital in Europe. Step 2. Look for a broad market index fund. Examples include S&P 500 Index Fund, Total Stock Market Index Fund, MSCI World Index Fund. Step 3. Set up automatic investments. Even 25s a month makes a difference. Consistency is key. Step 4. Hold long term. Don't panic when the market dips. Stick with it. If you want to try a mutual fund, follow the same steps. Just search for actively managed funds. But always read the fund's prospectus. Check the expense ratio. Look at its historical performance. And remember, past performance does not guarantee future results. Let's wrap this up with a quick recap. Mutual funds are actively managed and more expensive. Index funds are passively managed and lower cost. Mutual funds try to beat the market, but often don't. Index funds follow the market and usually outperform active funds over time. If you want simplicity, low fees, and long-term gains, go with index funds. If you want customized strategies and believe in skilled managers, explore mutual funds. The most important thing isn't which fund you pick. It's that you get started. Investing just £25 a month can grow into thousands over time. Start now, stay consistent, and let time do the heavy lifting. Thanks for watching. If you found this video helpful, hit that like button, subscribe to Money Map, and share this with a friend who needs to start investing today. Want to learn more? Watch our video on how to start investing with little money next. Link in the description. And if you're ready to start your investing journey, download our free beginner's investing guide, also in the description. Remember, your future is built with the small steps you take today. See you in the next video.